Welcome to the continuing session of EdupediaWorld.com, your online portal, the world of invaluable knowledge. So, during our last discussion, we are talking about the capital asset investment function, wherein we try to appreciate that investment decisions are those decisions which are concerned mainly with the decisions regarding investment into the long-term assets, the capital assets. We have also seen that the first function, that is a finance function, is incomplete without investment functions, because once finances have been raised by exploiting the various sources, they need to be deployed into the asset, into procurement and purchase of long-term assets, with the help of which the future revenue generation can come by. Now, in this session, we shall be trying to understand some of the remaining concepts. So let's start where from we left it. So capital asset investment decisions are crucial from the very onset. Why? So we have also already discussed, we have talked about this, that capital asset procurement or capital asset investment decisions happen to be one of the most crucial areas of decision making for the finance manager. Now the question arises, why? You shall see that there are certain points which we shall be touching upon. The first point being, they involve a huge funds outlay. Substantial amount of raised funds are invested into capital assets. It goes without saying, we have already talked on this particular issues, that capital assets do not come for cheap. They are not inexpensive, rather they are very expensive. So capital assets, there are certain features we talked about, that capital assets are expensive. They are not meant for quick resale. Once they are being commissioned, they cannot be reversed, they cannot be revoked, which we can also see from the slides also. When the decision has been taken regarding the procurement of the capital assets, the finance manager has to be very careful regarding the purchase of the capital assets before purchasing them, because once when they have been purchased and the options which are available to the finance manager are very meager. So whatever profitability, whatever risk profiling, whatever uncertainty need to be taken into consideration for the distant future, that should be done at the very onset. That should be done before purchasing the capital asset. After deploying a huge amount of financial resources, if the finance manager finds that the assets are not of the superior quality, they are not generating returns as much they were supposed to do, taking a toll on the financial resources towards repair, maintenance, they are breaking down quite often, then in that particular case, it becomes a very onerous burden for the company to take it forth. So we have also seen that long-term assets time frame extends up to 15, 20, 25 long years. So whatever purchasing or whatever investment we are doing right now, its implication, whether good or bad, it is going to last for at least 15, 20 years down the line, for the 15, 20 years to come. We have also seen that one of the most vital quality, what are the most vital property of a capital asset is that capital assets are always expected to generate capital assets are expected to generate a steady stream of revenues for the companies in the years to come. So if the assets are sitting idle, simply consuming the costly financial resources have been deployed into it without generating a return, so such kind of capital assets become absolutely useless for the company. So the utility and the usefulness of capital assets should be by the financial manager at the very onset, at the beginning, after purchasing and after deploying the funds, the costly funds, the scarce funds into the long-term asset. It becomes very difficult for the finance manager to revoke or reverse his or her decision. So last but not the least, capital assets are expected to generate the long-term revenues for the firm. We have already discussed this particular point, that capital assets are not expected to sit idle in the business. Rather, they are expected to harness themselves. They are expected to exploit themselves. They are expected to contribute wholeheartedly towards the production process, and with the help of the other functional areas, those produced goods and services are being sold in the market against a monetary consideration, which eventually becomes the top line or the sales revenue for the company. So with the proper synchronization of other functional areas, it becomes very imperative at the very onset that the capital assets, they are really firing all the cylinders. They are performing well in the production activity. They are being taken care of, and they are helping a seamless production so that it can be converted into the sales revenue in the days. They cannot be easily liquidated without inflicting a huge financial loss in case they turn out to be unyielding. This is one point which I will like to draw your attention towards. Like, suppose if the finance manager has invested the costly funds into the capital assets, and after the deployment of the asset, after the commissioning of the asset, if the finance manager finds that the assets are not unyielding, in that particular case, as I already told, the finance manager is left with no other option but to resale it into the market. And this resale process, it causes a huge financial catastrophe, because whenever such long-term asset is to be liquidated utilizing it completely, this such asset cannot be resold in the market without inflicting a huge amount of financial cost. So due consideration should be taken at the very that such kind of a condition do not arise in which the finance manager is being to resell the asset against a huge financial financial loss. So such kind of condition should be avoided. So by all these accounts, we can say that investment decisions are another set of the crucial decisions which the finance managers are required to take besides the financial decisions. The last but not the least is the liquidity decisions. Of the three financial functions happen to be the decisions related to the liquidity position of the firm. Now, what do we mean by the word liquidity? What do you mean by the word liquidity position? So the term liquidity means the ability for the assets to be converted into a cash without inflicting a huge loss of time and value. I once again repeat, liquidity refers to the property of the assets to be converted into the cash without incurring a huge loss in terms of time and value. So liquidity decisions are both short-term as well as long-term in nature. Liquidity and profitability. Liquidity, profitability and solvency. There are three parts. There are 3 points which play a very crucial role, which we shall be seeing eventually into our discussion. But right now, let's talk about the fact that liquidity decisions are both short-term as well as long-term in nature. Short-term liquidity decisions are focused on the working capital management, while long-term liquidity decisions target framing of a dividend policy. Now, let's forget about the dividend policy right now. Let's try to focus on the short-term liquidity management, that is the working capital management. As I've already said, that liquidity means the easy availability of cash. Liquidity means the easy availability of funds within a business entity, with the help of which the daily operations can be managed. From over here, we are finding the word working capital management. Now, what do you mean by the word working capital management? In a layman's term, we can say that working capital management refers to the process of managing the working capital. In a very simple term, we can say that working capital management refers to the management of the working capital. Now, again, a pertinent question arises, then what exactly is working capital? So, working capital can be best described as that part of the total capital which is used to carry out the day-to-day operating activities of the firm. Once again, student, it is a very simple concept. Working capital may be best described as that part of the total capital which is used to carry out the day-to-day operating activities of the firm. We have already seen from time and again, I have been due importance on the point that the main two areas where financial resources are being put to use are: number one, financial resources aid in undertaking the economic activities. Financial resources aid heavily in production activities, and secondly, we have seen that financial resources play a very crucial role in ensuring that all the other functional areas, they are acting in sync with each other so that the finally produced goods and services can be easily sold in the market against a financial consideration, thereby leading to an economic profit. Now, the second part, the working capital management, is mainly focused on the second part, that working capital is that part of the total capital which is not long-term in nature. Working capital do not have much of a bearance on the long-term functioning of the company. Rather, as the name suggests, working capital is that part of the total capital which aids the company in maintaining her day-to-day operating activities of the firm. So, how can we define the word day-to-day operating activities? Right now, just now, a few minutes ago, we saw that long-term funds deployment are being done in order to procure the long-term assets, in order to purchase the capital asset, with the help of which, at least for 15-20 years, they are expected to yield revenue for the firm. But day-to-day operating activities, they act as a feeder. Day-to-day operating activities are those operating activities which need to be done daily. And the best examples are purchase of raw materials, payment of rates, payment of wages, payment of salaries, payment of insurance premium, payment for the other utilities like gas, heating, lighting, etc. It means that if day-to-day operating activities are not taken care of, then obviously the long-term usage of the capital assets will be badly hampered, because students, we have already seen while discussing the production activity, that in the case of production activity, capital assets do play a very crucial role. But capital assets are of no use. Capital assets cannot be of any use for the company if they are not being provided with feeders like your raw material, if there is no labor force to harness the machinery by providing them with raw materials, so that the transformation can take place from raw material to semi-finished good to the finished good. If there is improper utilities, if there is a poor lighting, poor heating, poor electricity supply, then obviously even if the machinery is of a superior quality, it cannot really be harnessed. Secondly, many a times we have seen that raw materials need to be purchased, and the raw materials are purchased usually against cash, and even the raw materials at times they are purchased against credit from the creditors or from the suppliers. So in order to ensure a seamless supply of raw materials, in order to ensure that there is an supply of the raw materials, we have to ensure that the firm is having sufficient amount of liquid cash at her disposal, with the help of which she can pay for the cash upfront, or even the company should have such a reputation amongst the suppliers and the creditors that even if a need arises to purchase them at a deferred payment system, it can be purchased. Then secondly, students, you will find that when the final production has been done, they need to be transported far and wide amongst the marketplaces, amongst the distributors, where can the end users can come and buy them. So this transportation charges also involve a lot of carriage expenses, transportation expenses, and in order to pay for these expenses, the company should be ready with liquid cash. The company should be ready with easily available cash, and such availability is known as the liquidity. Secondly, many a times the company tries to sell off the goods into the market against the cash purchases, but many a times it might happen that the company might be forced to sell her goods, her services, her wares against credit. So such credit sales give rise to sundry debtors, who are also the part of your current assets. So we see that in a technical term, we denote current asset and current liabilities are the part of the working capital. Just like we are having the long-term liability and long-term asset, in the same fashion we will find that current assets and current liabilities, they play a very crucial part of the working capital. And the word management is there because if working capital is being poorly managed, if the liquidity position is being poorly managed, then what will happen? And obviously we have seen that the day-to-day operating activities will be badly jeopardized, will be badly hampered, and this will take a toll upon the performance of the long-term assets. So let me at this juncture, let me make one thing very clear, that it is not so that only the management of the long-term assets is important. Of course, management of long-term assets is very, very important, but at the same time, the management of working capital or the liquidity management is equally important from the profitability and the wealth creation point of view. If the long-term assets are not being timely, the working capital or the raw materials, their functioning will be badly jeopardized, which will not be in the best interest of the company. Now, the management of working capital is extremely important on a day-to-day basis, because if the short-term liquidity of the firm is not managed, then the daily operating activity gets seriously jeopardized. This is the same point I have been highlighting right now, that if there is a poor synchronization between all the functional areas, then obviously the things which have been already produced, they cannot be liquidated, they cannot be sold in the market, and this will seriously hamper the profitability of the business, the revenue of the business, and the reputation of the business. A trade-off needs to be struck between liquidity and profitability. This is one very important point, students, that a trade-off needs to be struck between liquidity and profitability. We shall be highlighting this, I'll be dedicating a complete chapter on working capital management, but as if now, let me make the thing very simple, that an astute financial manager should always try to strike a balance between liquidity and profitability. It means what? What is the meaning of the word trade-off? Trade-off means the finance manager should strike a even balance. There should not be any unevenness. There should be a symmetrical balance tied between the liquidity and profitability. The finance manager should take a proper decision regarding how much liquidity he should have in the firm and how much profitability he should have in the firm. It simply means that if a finance manager is keeping too much of liquid cash at his or her disposal. Please try to understand me. Suppose if a finance manager is trying to keep too much of a liquid cash at his or her disposal for the sake of increasing the liquidity, it means what? It means that the finance manager is left with lesser amount of financial resources to deploy into the long-term assets. So if it means that if a finance manager is having a vision of keeping higher amount on the liquidity, if the finance manager is more inclined, if he is more tweaked towards having a higher amount of liquidity, then obviously he will have to he will have to sacrifice the profitability part. Why? Because the funds at his disposal is limited. It is not that for liquidity he is having some other supply and for profitability he is having some other supplies. He has got only one combination of the fund which he has raised through the first function, that is the financing function, and from that total finances, from that total cash at his disposal, funds at his disposal, he has to segregate, he has to make a proper rationing that how much of money should be dedicated towards the liquidity purpose and how much of the money should be dedicated for the profitability purpose. So if he is having a higher liquidity, it means if he chooses to have a higher portion of the entire funds raised towards maintaining the liquidity, it goes without saying that he shall be having lesser amount of funds at his disposal for deploying into or for purchasing the long-term assets. And students, we have already seen that without the long-term asset, without the capital assets, profitability or the motive of earning profits year after year after year can never be possible. Working capital, they act as a support. Working capital or current asset or current liability or day-to-day operating expenses funds, they cannot guarantee the firm a long-term movement, or they cannot guarantee the firm a long-term profitability. They are best supported. They are acting as a supporting role. They are acting as a second fiddle to the long-term assets, so that the long-term assets can work seamlessly, work in an uninterrupted fashion for 15-20 years down the line. On the other hand, if the finance manager is very aggressive, many a times, actually the thing is that it is a financial manager's approach. If a financial manager is more inclined towards liquidity, we call such managers a bit conservative in nature. They are more conservative. On the other hand, if a financial manager is more inclined towards earning a profitability, it means that he is more aggressive in nature. If a finance manager is aggressive, if he is having more of an emphasis laid upon on the profitability part, it simply means that he is not very much keen towards having his hands liquid. Rather, he is of the opinion that whatever funds have been raised against the cost of capital, the chunk amount of the fund should be deployed in the long-term assets, so that the long-term assets can be used to generate the long-term revenues for the company. So if he is more on the profitability, it means he is trying to ensure the future. He is of the opinion of purchasing of or investing the better quality of long-term assets, so that the long-term profitability can be generated, but in the process he is seriously compromising with the liquidity part, which is again a poor concept, because long-term assets performance cannot be maintained, it cannot be upheld if they are not being supported with the raw materials part and the liquidity part. So neither a finance manager should be too conservative. That is, neither a manager should put too much of an emphasis on the liquidity, nor a financial manager should be too very ruthless and aggressive. So which means that he should not only focus on deploying the entire set of the fund into the long-term assets, thereby sacrificing the liquidity. So a proper trade-off needs to be struck. A finance manager should have a balanced view between liquidity and the profitability. More to it when we shall be discussing the chapter dedicated on the working capital management. Now students, we shall be talking about the long-term liquidity decisions. So the long-term liquidity decisions are concerned with designing a dividend policy for the firm. So students, we have already discussed in our previous slides. Let's have a quick recap. What exactly is the meaning of the word dividend policy? Obviously, again in layman's terms, dividend policy can be segregated into two parts. It is a policy which is concerned with framing of a dividend decision. It means dividend policies are those policies which are concerned with the decision regarding payment of the dividend. Now, what is a dividend? So, dividend, we all know, dividend represents that part of the divisible profits. I once again repeat, dividend refers to that part of the divisible profits which are being segregated, which is being distributed amongst the equity shareholders depending upon the number of equity shares they are having into the company. I once again repeat, students, dividend refers to that part of the dividend of the distributable profits which is being distributed amongst the shareholders at large depending upon the number of shares they are owning into the company. So, dividend payments are a matter of sole discretion by the management. We all know that equity shareholders, they are the real owners of the company. So, whatever stake they are having in the company, that stake is being represented by the number of equity shares they are having at their disposal. And based on that particular disposal, based on those number of equity shares the shareholders are holding, the dividends or the divisible profits are being distributed amongst them. Regarding dividends, we have already discussed that dividend payments are not obligatory on the management of the company. They are not. It means that the management is not obliged to pay a dividend as and when it arises. And secondly, payment of dividend is subject to the availability of profits. Unlike the interest payment, dividend payments, they are not a charge against profit. Rather, they are just an appropriation of the profit. So, the 2 points which become very pertinent over here, that dividend payments are it is a matter of a sole discretion by the management, number one, and number two, dividend payments are not a charge against profit, rather they are appropriation of a profit. It simply means that even if there is a profit, it will totally depends upon the discretion of a management whether she wants to pay a dividend to the shareholders, or it might be the case also that even in case of a loss, the management might decide in favor of payment of a dividend by using her reserves and surplus or dividend equalization fund as the need arises. So the shareholders do not have a full control over the management regarding the payment of a dividend. But dear students, let me make one thing very clear. But theoretically, it seems that the shareholders are at the receiving end. They are not getting any guarantee of return of their capital. Unlike the debenture holders, their dividend payments are again, it depends totally. It is at the mercy of the discretion of the management. Moreover, the dividend rates are not fixed; they are erratic. Even the dividend payments are subjected to an appropriation of a profit. But in real life, let me tell you one thing: the managers take a due consideration. The managements are very diligent on while designing a dividend policy, because as we shall be seeing in the future, that design of a dividend policy has got a very far-reaching ramifications towards the shareholders' behavior or shareholders' impression regarding the company, regarding the future wealth creation process, and even proper dividend policy can inspire a lot of confidence amongst the shareholders, and a poorly framed dividend policy simply destroys the equity shareholders' confidence, and equity shareholders always have a full right, they have got a full liberty that after their shares have been listed on a stock exchange, they can simply sell off their share in the market and they can take their money out, which is not always in the best interest of the company. So, on theoretically, whatever the thing might be, but in real life, let me make one thing very clear, that financial managers are very, very careful. They are very, very cautious while designing while designing a dividend policy. Dividend policies are neither very strict nor they are very lenient. And second, the most important point, dividend policies are not expected to be erratic. So whatever dividend policy is once being framed, managers always try to stick to one particular dividend policy for a number of years down the line, so that a kind of a confusion is not created in the mind of the shareholders. Now, dividend policy decides the amount of cash to be distributed among the shareholders as dividends and amount to be withheld as retained earnings. Now, one important point, one pertinent point which comes to the fore is the word called retained earnings. Now, what is the retained earnings? You might be remembering when I was talking about the financing decisions, when I was talking about your sources of finance, I talked about retained earnings. That retained earnings and reserve and surplus, they are part of the part of the sources of finance. We talked about the equity financing, we talked about the debt financing, then we talked about your retained earnings. Now, what exactly is retained earning? As the name suggests, that retained earnings belong to the shareholders even if they are not distributed instantaneously. It simply means retained earnings. It means it is that part of the earning. Again, retained earning in a very layman's term, we can say that retained earnings refer to that part of the earnings which are not been distributed, which have not been distributed amongst the shareholders as dividend, but rather some portion has been held back by the company. I once again repeat, like suppose the earning per share or the net profit after tax for a company is figuring out to be $10 per equity shares. The management might decide upon a 40-60 ratio. It means that the management might decide that out of the $10 of after tax profit, 60% should be distributed amongst the equity shareholders, whereas 40% should be held back by the company. It means that 60% of 10, that is $6, should as a dividend outrightly, and 4% may be retained back by the company. Now, this $4 which has been retained back by the company, one thing, let me make it one very sure, student. Usually, people are misunderstanding that the $4 which have been withheld by the company as a retained earning, that becomes a property of the company. No, it is not so. The company is just a custodian for the $4. At any point of time that the retained earnings of $4, it is the amount which has been earned by the shareholders. That $4 in addition to the $6 become to the shareholder, and they belong to the shareholders. The only difference is that the $6 have been paid outrightly, whereas the $4 have been held by the company, and the company acts as a custodian for the $4 which have been retained by the company. Now the question arises, why exactly the company wants to go for this way for retained earnings? Because as a dividend policy, as I've already said, from the dividend policy, the manager decides that how much of the amount should be paid out as a dividend and how much of the amount should be withheld in terms of the retained earnings. It means that when the company is putting certain amount as a retained earning, the company is trying to build up a cash chest with the help of which in future the company might exploit any such expansion plan. That the company might invest into more lucrative assets with the help of which more and more wealth can be created in the future. Because if the company is distributing the entire amount as a dividend, payment of a dividend always entails a huge cash outflow for the company. It takes a financial toil upon the company. If the company is finishing off her hand, if the company is exhausting all her cash resources in payment of the dividend, then the company will be the company shall be facing a huge cash crunch. And in the mid future, if the company finds a more lucrative opportunity to purchase a new business or to purchase a new asset, the company won't be having any cash, and in that particular case, the company will have to again, the finance manager will have to again try to raise the finance by exploiting other external sources, which will be a very costly affair. So the shareholders try to get the managers try to give a assurance to the shareholders that if they are willing to part away with their earnings as a retained earnings for a few time frame, then the managers are giving them a hidden assurance, an implicit assurance that that particular money shall be safely kept by the company as a custodian, and in the near future, whenever a more lucrative option crops up, that particular retained earnings shall be used to avail that particular opportunity, purchase that particular asset, with the help of which the company can have a better product portfolio, or the company can enjoy a better goodwill or a better market positioning, which will eventually help the shareholders in earning a higher earning per share or a higher dividend. So always remember, student, that the retained earnings, even if the company is holding back that particular amount on behalf of the shareholder, that amount does not belong to the company at any point of time. It is the money which belongs to the shareholders, and the company merely acts, or the manager merely acts as the custodian of the same. So now you can see that dividend payments represent a huge cash outflow, whereas retention results in cash conservation for future expansion and asset purchases. A stable dividend policy is highly recommended for value creation, and it inspires confidence amongst the shareholders. Rightly said, as I already told, if the dividend policy is erratic in nature, you will find that the shareholders come under a lot of confusion regarding the safety of their capital or the payment of the dividend. So whatever dividend policy is being framed, it has to be framed very, very cautiously. It has to be framed very judiciously by the managers, and once it has been framed, the managers or the company should stick to it for a considerable time frame, so that it should inspire, it should instill a faith or a confidence in the heart of the shareholders. So dividend policy always plays a very crucial role in maintaining the long-term liquidity portion of the company. So long-term liquidity, how it is being maintained? Certain amount is being distributed as a cash, and the amount which is being retained by the company as retained earning, that acts as a reservoir for which creates a cash chest with the help of which the future lucrative projects can be earned. And at the same time, I would like to say, students, that if the company finds, that manager finds that there is no sufficient amount of an investment opportunity coming up in the near future, in that case, the managers try to distribute the entire amount as a dividend payment, thereby not having a single penny as a retained earnings. It all depends upon the manager's perception regarding the future opportunities which might lurk around the corner, because ultimately we know that the finance manager's goal is to maximize the wealth for the shareholders in the years to come. Okay, students, this is for now. We're concluding it right now. Thanks for being with us. Thanks for listening to the Edupedia World videos, your online gateway to the world of invaluable knowledge. In the next sessions, we shall be taking up some more interesting aspects of financial management or the finance decisions. Thank you for listening to us.